You wake up and every dollar bill just stops working. Stores refuse cash, but your digital wallet still pings to life. Overnight, the US dollar is now purely digital, moving at lightning speed under government control. Is this new system just evolution or something altogether riskier? Before you decide, here is how the digital dollar would actually work, and why its biggest trade-offs start where convenience ends. Every digital dollar needs a home, a place where balances live, and a way to prove who owns what. In a fully digital system, two main models compete for the spotlight. The first is account-based. Every user holds an account, either directly at the central bank or through a bank or wallet provider. Every transaction updates a central ledger, and identity checks are built in from the start. The second is token-based, where digital dollars work more like cash. Whoever holds the token owns the value, and identity checks happen only when users enter or leave the system. Most real-world pilots, from the Bahamas to China, rely on intermediaries like banks or payment apps to manage wallets and verify users. Before spending or receiving, each person passes through identity checks such as know your customer rules, PINs, sometimes even biometrics. The design choice, account or token, direct or through intermediaries, shapes how fast payments move, how private they can be, and who gets to participate. Central banks don't build digital dollars on a whim. They're chasing concrete goals, lowering costs, speeding up payments, and reaching people left out of the traditional system. Sending money across borders can take days and cost up to 7% in fees. A digital dollar could cut those costs in half and move funds instantly, day or night. For millions without easy access to banks, a government-backed digital wallet could mean joining the financial system for the first time. Governments also want stronger tools to fight fraud and deliver emergency aid. During the 2020 stimulus, direct digital payments reached most Americans in hours, while paper checks lagged behind. But none of this works if the technology can't keep up. In the US, Project Hamilton proved a digital dollar could process 1.7 million transactions per second, outpacing even the busiest credit card networks. The promise is a system built for everyone, working at the speed of life. A parent facing a sudden emergency receives government aid in seconds, not days. The money appears in a digital wallet, ready to cover groceries or rent before the crisis can spiral. For a migrant worker sending wages home, the change is just as real. What once took days and cost a week's pay in fees now moves instantly, with more money reaching family instead of middlemen. In the Bahamas, the sand dollar cut remittance costs by up to half and delivered funds even in remote islands. When help arrives right when it is needed, the difference is felt in every household. A freelance journalist publishes an article online, and within minutes readers send tiny tips, just a cent or two, directly to the journalist's digital wallet. In the European Central Bank digital euro pilot, these micro-donations prove possible, with payments of €1 flowing instantly and without high fees. For creators, musicians, and independent writers, a fully digital dollar could unlock new ways to earn from every podcast episode or newsletter, no matter how small the audience. Where traditional payment systems make such small transfers impractical, a fully digital dollar makes them viable, opening fresh revenue streams for anyone with something to share. A small business vendor in Nassau remembers the first week after the sand dollar launched. Tourists stepped off cruise ships waving cash, but the vendor's new QR sign could not take their tips. Sales dropped by nearly 20%, and the familiar clink of coins at the end of the day faded. In digital-only systems, every payment leaves a trace. Privacy advocates warn that even a morning coffee becomes part of a permanent record, open to analysis by banks, payment apps, or, in emergencies, by governments. In 2022, over 200 Canadian bank accounts were frozen under emergency orders, with individuals learning only when their cards stopped working. In India, a payment network outage once stalled gig workers' earnings for hours, leaving millions unable to pay for food or rides home. For older adults, the shift is even harder. Federal Reserve data shows that 36% of seniors prefer cash for person-to-person payments, more than double the rate of younger adults. Without cash, Many face friction at checkout, struggle with unfamiliar apps, or lose the anonymity that lets them buy medicine or groceries without leaving a digital trail. In a fully digital world, outages, freezes, and the loss of cash's anonymity are not just technical glitches. They reshape who can pay, who gets paid, and who is left out. Technical fixes and legal guardrails are already in play. In Europe, central banks piloted zero-knowledge proofs, math that lets you prove a payment is valid without exposing who paid whom. Offline smart cards, capped at a few €100, allow small anonymous purchases without an internet connection. Privacy advocates push for hard limits on when accounts can be frozen, requiring court orders and independent audits. Meanwhile, the open source world points to Bitcoin. Its network runs without a central authority, and no one can freeze or reverse a transaction. But Bitcoin's transparency means every payment is visible on the public ledger, and using it safely demands digital know-how. The choice is not just between cash and code, but between competing definitions of trust and control. Tomorrow's money could track every move or open doors we can't yet see. The real question isn't about technology, it's about trust. Who holds it, and who decides when it's spent?